This is Matthew Cratter from Trader University, and today I want to talk about whether the stock market is overvalued. If you're interested in learning how to make money in both bull and bear markets, or just want to see what I'm trading these days, be sure to hit that subscribe button. So, still seeing a lot of articles like this about how the stock market is overvalued and getting a lot of emails and questions from listeners. So I wanted to talk a little bit about this. So we're going to do a very simple exercise here. I'm going to use some really rough numbers. You can adjust the numbers as you see fit. The S&P 500 yesterday closed at about 3145. If we we want to come up with an estimate of what the S&P is going to earn this year. The market is always a forward discounting mechanism. It tries to price things looking ahead. So what I did is I used Yardini Research here, a paper which I'll link to, and he's got full year 2020 earnings at 124.81. What I'm doing is I'm just going to take the first quarter earnings, which is about $33. These were the actual earnings that S&P 500 companies reported in the first quarter of 2020. And this number looks a little bit high, but you can adjust it as you want. So that if we use that number and we annualize it, so we just basically multiply it by 4, we end up with earnings this year of about $132 per share for the S&P 500. That gives the S&P 500 a PE of about 23, almost 24, a little bit above where CNBC is saying it in this article. You can look at earnings for the past 12 months. You can look at projected earnings for the forward 12 months. So there's forward earnings. There's a kind of a forward PE for the S&P 500. There's a trailing PE. I'm using kind of a mixture of those by extrapolating the first quarter. If we do that, though, we come up with a PE of 23 or 24, which is historically high. If you go back and look, the average PE, the median PE or the average PE, depending how you want to do it, is somewhere closer to, I seem to remember, 16 or 17. But this is sort of historically high. On the other hand, PEs have been historically high for the S&P 500 really for the last 20 years. And I've been hearing for the last 20 years that the stock market is overvalued, and yet it keeps going higher and higher. So there must be something else at work. Now, one way to think about the PE is to take the inverse of it. So if the PE is the price of the stock or the price of the index divided by earnings, the earnings yield is just the inverse. It's the earnings of whatever it is, the stock or the index divided by the price. So if we just invert this, we do 1 over 23.73, we end up with an earnings yield of 4.21%. Now this is helpful because in finance and in investing, we often think of yields. So for example, right now, the 10-year Treasury yield's about 0.66%, less than 1%, which is really hard to believe. So let's compare the S&P 500 earnings yield to some other investable universes. We can look at Moody's investment grade bonds. These are very blue chip companies, and currently right now, this index, if you buy this basket of bonds, which is a good indicator of where the bonds are trading, about 2.33%. Now this makes sense. Bonds are ahead of equities. They're ahead of ownership in the capital structure. So they should trade, they're less risky, so they should trade at a lower yield. Now, obviously the S&P 500 is not all investment grade companies, so I am simplifying here, but I'm trying to use really rough numbers, as you'll see. So right now, stocks, in terms of their earnings yield, trade at about 1.88% above the equivalent bonds. Maybe it's a little bit less than this because not all the bonds in the S&P 500 are these sort of seasoned. What I'm using is Moody's seasoned corporate bond yield index here, which I'll link to. But let's say that stocks should trade at about call it 2% above where bonds are, 1.88%. The thing about these bonds now is that they are no longer risky given current Fed policy. If the yields on these bonds move up too much, the Fed will buy them. They're buying junk bonds, which are even more risky. They're buying corporate bond ETFs, and they're also now buying individual corporate bonds. So what this means is that the default risk of these bonds is very, very low. What can happen, and also the risk of the yield spiking or the price of these bonds going down is very low, because what will happen if this happens, as it did in March, the Fed will step in and just buy more of these, and the Fed can print unlimited money. So what I would argue is that these corporate bonds are not much more risky than US Treasuries. They're essentially backed by the Federal Reserve. Now, maybe they're not quite as safe as Treasuries. Maybe there's some sort of risk spread there. So if we look at the 10-year Treasury note, and we're assuming all these, this corporate bond index is about equivalent to 10-year bonds. But the 10-year Treasury, which is quote-unquote risk-free, is trading at about 0.66. Now let's say that investment-grade bonds are slightly riskier than this, but still not that risky, simply because they have a Fed put behind them. So let's say this corporate bond index, the yields should really be closer to 1%. That's at a spread, a little bit of a spread above where Treasuries are trading, because they still possibly, maybe the Fed changes their policy and they stop buying them, etc., which is extremely unlikely. The Fed is going to have to do this for the rest of our lives until there no longer is a Fed. But let's say these corporate bonds should really trade at about 1%. As we saw, they're currently trading at about 2.33%. But let's say that the actual risk on them is much, much lower. And it is much, much lower because we know the Fed is buying them and is going to have to continue to buy them. And so if these corporate bonds should trade at 1%, and we agree that the earnings yield should be about 1.88% above where the bonds are, this implies an earnings yield for the S&P 500 of 2.88%. Obviously extremely low. But what is happening here is the Fed is using yield curve control. They're compressing spreads, and they're basically intervening across all of these different asset classes. Now, earnings yield of 2.88% for the S&P 500, if you just flip that over, if you do the inverse of that, 1 over that percentage, that implies a PE of 34.72 for the S&P 500. What we're doing is we're just saying that stocks are a little bit more risky than corporate bonds. Corporate bonds are a little bit more risky than Treasuries. And what sort of PE does that imply for the S&P 500? Now, if we just use these regular earnings per share that we were using before, 132, this will be 2020 earnings. Maybe the number is a little bit lower. Ed Yardeni has it at 124.81, so you could use 125 for this number. It's not going to make a big difference. Basically, you just take earnings per share for the S&P 500 for 2020 times the expected PE, the PE where the PE should be, and you end up with the S&P trading at 4,600. This is why a lot of people are saying the S&P could easily go above 4,000. I think it could easily go above 4,000 this year. And for perspective, it's currently trading just at 3,100, 3,145. And so this is obviously a huge rally. But what is happening here is that the Fed is expressing itself all the way across these risk asset classes by intervening in the bond market. And what this implies is, contra CNBC, a PE of 21 or 22 is actually much too low, given the fact that the Fed has committed to propping up these markets. Now, if something could obviously change, you could have an entire new leadership, but it doesn't seem to be what's going to happen. We have this sort of Fed policy that's really been around since Greenspan of propping up stock prices, and now we're at the point where the Fed is actually printing all this money, adding these assets to their balance sheet. They're no longer adding, they're not buying equities yet, as the Bank of Japan has done in Japan, their central bank. But we're essentially there, simply because if you say that investment grade bonds are no longer risky, what this means is that the S&P 500 should trade at a much higher PE as a basket. Now, what does this mean if the S&P goes to 4,600? I don't have the exact number for you, but Plan B, according to his model here of the S&P 500 and Bitcoin, if the S&P 500 just goes to 4,000, again, we're talking about it going to 4,600, but if it just goes to 4,000, if this cointegration model holds, and again, there's no reason that it has to, but it has been a good model up until this point, that implies a Bitcoin price. If the S&P is at 4,000, Bitcoin price of 190,000 per Bitcoin. If the S&P 500 goes to 4,600, that definitely gets us into the $200,000, $300,000 range per Bitcoin. I think that is where we're heading. You can get angry about what's happening with the central bank, all this intervention. We just heard this morning, just a couple minutes ago, that Trump says that there's another round of stimulus checks on the way. This is the new reality that we live in. We live in a reality of perpetual stimulus, and this is all funded by the Fed that buys bonds from the US Treasury and gives Congress this money to spend on stimulus checks. This is, I agree with Ray Dalio here, where he says that capital markets, really worldwide, are no longer free because of central bank action. So when people tell you the stock market's overvalued, when they compare it to something that was happening in the 1970s or 1980s or 1960s, you have to understand that we're in an entirely new regime here, where everything is controlled by federal decisions and it's controlled by central bank policy. So in that sense, this whole exercise we did is almost superfluous. The Fed wants the stock market to go higher, to go much higher over the coming years. And as a result, this is what's going to happen. We no longer have free markets here. This means that we should not be short the market. This was one of the main reasons I flipped bullish on Tesla, because when the Fed is saying that junk bonds are all going to be saved, that means Tesla has an unlimited runway. In the meantime, they've done some very good things as well. And it looks like the company is just going to continue to do quite well. But there is a Fed put now for junk bonds, for investment grade bonds, and for the stock market. I hate to say it, but you can throw PEs out the window, because we are no longer in a real free market. We are in a video game simulation, and these are the rules. These are the rules of the video game. This is why Warren Buffett has been underperforming for so long, because he doesn't understand this, or he refuses to agree with this. So this is one reason I'm massively bullish on stocks, massively bullish on Bitcoin, massively bullish on gold as well, because of all this Fed printing and because of all this central bank intervention in the markets. If you found this video helpful, be sure to hit that subscribe and like button. Let me know your questions, comments, criticisms in the comment section below. Thanks a lot for listening, and I'll see you in the next video.